In today's episode, I'm going to share with you some tips and tricks you can implement in your own trading starting today to help you get better at identifying whether a stock is about to dip and then rally for the next leg higher, or if it's about to dump. In order to be a consistently profitable trader, you need to have a strategy or a system, a set of rules that you follow consistently every single day. But there's no doubt that along the way, if you can learn a couple of skills to help you better identify what a stock is about to do, it's gonna help you a lot. So my goal for this episode is that by the end of the episode, you're able to identify whether a stock is gonna dip or if it's gonna dump. By understanding which is gonna happen, you will prevent yourself from over trading the backside of the move when a stock is trending down and when most traders are giving back profit. And instead, you're gonna be focusing on trading the front side of the move. This is gonna be the beginning of creating a positive feedback loop where your accuracy goes up, your profit loss ratio goes up, your confidence goes up, and you start feeling really good about what you're doing. So let's go ahead and jump onto the whiteboard. Now, as a momentum trader, I like to focus on stocks that are trending. But rather than buy at the very top right here, I would rather wait for a little pullback. The reason I wanna wait for a pullback is because if I buy down here on this dip, then my max loss is always the low of the pullback right down here. If I'm in right here and my max loss is right here, let's just say that's 1, my profit target is to make 2 times whatever I'm risking. So I want to have a profit target of 2 to 1. And it's very easy to achieve a 2 to 1 profit to loss ratio when you can get an entry with a very tight max loss. And that's the great thing about buying dips. You get in on a dip when a stock is pulling back, you're in right off of support, and if it holds, you've got a great entry and you can ride that next wave higher. The problem is a lot of beginner traders look at this chart right here and they can't tell if this is a dip they should buy or if this is about to dump. So I'm gonna help you gain some confidence to figure out what's about to happen. Let's go ahead and jump onto the screen share, and I'm gonna start this class with a little bit of a quiz. Now, I know you probably haven't studied, so don't worry, it's not gonna be too hard. I'm gonna show you a case study from today. Now, this morning, I had a pretty nice green day. We're gonna recap those trades because a lot of the trades today, the profits were produced by buying these dips. So what do you think this is gonna do? Is this a dip where I should be a buyer, or is this gonna dump? All right, I hear you saying you think it's gonna dump. Wow, wrong, and not even close. You're completely wrong. This was a dip that we wanna buy. But how do I know? How did I know beforehand that that was a dip that I should buy? Because I did buy that dip, and my profit today is $37,000. So the way I knew that I should buy that dip was because I was looking at a couple of very specific indicators. I was looking at the profile of the volume, I was looking at the position of the moving averages, and I was looking at the position of the MACD. These indicators give me an edge when I use them consistently. Now, indicators are not going to be helpful if you don't use them consistently. You have to use them every single time on every single trade in order to figure out whether or not they're actually helping you. Now, I'm going to walk you through the indicators that I use, how I've got them set up, exactly what the inputs are that allow me to get these signals, because ultimately, this is giving me buy and sell signals. I see them plain as day right on the chart because my eye has been trained to see them. Now, if you don't see them yet, it's okay. It's because you haven't yet learned this language. The language right here that we're talking about is the language of technical analysis. This is a universal language of the financial markets, and my goal is to teach you how to read it and how to fully understand it. So this was an example of a dip where we got the nice rally higher, a perfect opportunity to buy a strong stock on a pullback and catch that next wave up. Now, this is a stock that happens to be a biotech stock. They had phase 3 clinical trial results this morning. That was the news that came out way back here at about 7 a.m. that gave it this big boost of momentum. There was a catalyst that was driving the stock higher. Let me give you another example. All right, so now let's look at it here. What do you think it's gonna do? Now, maybe you already kind of have an idea. Is this gonna dip or is this going to dump? You say it's gonna dip and we should buy it, right? Wow, wrong again. Okay, guys, seriously, let's try to focus here. I want you to get better at this. So what happened here? You said it was gonna dip, but it sold off. Did you even check the MACD? Let's go back, let's check that MACD. The moving average convergence divergence indicator right there, it was negative. That's not a dip that we can buy. MACD's negative. That's a no. We got to wait, and that was the right move. It ended up pulling back down to 1050. All right, so these are the topics that we're going to cover in today's class. Indicators of a likely dip, indicators of a likely dump, or inverted. Dump first, and then we'll do the dip. Number 3, the type of stocks I like to buy dips on. And number 4, I'm going to show you where to buy, where I like to buy, and where I like to sell for my strategy. If you're trying to learn a momentum strategy like mine, what I encourage you to do is to start practicing everything I'm going to share with you today in a simulated environment. In a simulated environment, you won't risk real money. That's super important. All right, now let's go ahead and jump in to this class. Here, let's do another quiz. Is this going to be a dip or is this going to be a dump? Oh, now see, as I look at this, it's a little bit tricky because the MACD appears to still be open, right? But did you check the volume profile? We've got higher volume on the selling candles, and this is going to be a dump. It's going to go lower. So in fact, it's kind of amazing because as an active trader, when you get really good at this, you're almost able to see into the future. Of course, you could see in the future, years from now, you could do incredibly well in the market. I'm seeing in the future about 10, 15 minutes, but that's enough for me to do quite well. Maybe I haven't introduced myself. My name is Ross Cameron. I'm a full-time trader. I funded my first account with real money in 2001, more than 20 years ago. So I've been in and out of the market for a long time. I've been through some nice ups. I've also been through some difficult markets, some bear markets and some downs. And through all of that, I have developed a strategy that I've now traded full-time every single day for more than a decade. And it's a strategy that I will share with you guys, a little kind of pieces of it here through this episode. To teach you the whole strategy would take far longer than I have time for in this episode. We're going to try to keep this concise and keep it focused on dips or dumps. Let's do another quiz. All right, so what do you think is going to happen here? Okay, so this is a stock that rallied up, nice big rally all the way up here to, I can't tell what that price was. I lost my price scale. It pulls back, it rallies back up, it pulls back, it rallies back up. Is this going to dip and rip, or is it going to dump? What do you think? It's going to dump. Why is it going to dump? High volume red candle right there. See that high volume red candle? That's an indicator that's going to dump. All right, so let's go and talk about these indicators for a dump. Number 1, if we have a high volume red candle, like you just saw here, a high volume red candle indicates people are just selling. They're bailing on the position. Think about supply and demand. When you have a lot of sellers, they're creating a lot of supply. They're saying, I don't want this stock. I'm ditching it. I'm dumping it. I don't want to hold this position. They're creating supply. Demand is created by the buying volume as the price is going higher. So although this did have some nice buying volume at the beginning of the move here, unfortunately, the selling volume on this candle was so strong and so dramatic that it created kind of a lasting sentiment where even as the stock was pulling back, people were looking, and that was the most recent candle they were seeing. A high volume red candle, even if the MACD was going positive right there, it wouldn't be worth trusting that setup when you're in the shadow of a big red candle like that. So one of the first indicators for a possible dump is when you have a high volume red candle. And this is especially true when that candle is near the top of the move. Or in the case of the example that I showed you just before, and I'll just show you that instead of drawing it out. If we look at this example here, this also had that high volume red candle. These two high volume, there's really 4 of them. What this tells me is that, yes, the stock popped up, but the move up was on relatively light volume. The move back down was more convincing. In total, there was more volume to the sell side. So the volume tells a big story there. That's going to be a consistent theme of watching the volume. So number 1, high volume red candle. Number 2, a large topping tail. So let's get on the whiteboard for this one. So when you have a stock that's had a nice rally up, it's been moving higher, you've got these nice green candles, and then all of a sudden up here, you have this big topping tail. What is that topping tail telling us? Topping tails are always bearish. The reason they're bearish is because while the price squeezes higher, which is good, ultimately sellers pull it back down. As they pull it back down and then the candle closes, they're the ones who win this battle. Each candle, in essence, is a battle between supply and demand and buyers and sellers. And when you've got large green candles, the buyers are winning the battle. Large green candles, especially on high volume, the buyers are definitely winning the battle. But up here, you have this candle that tells a little bit of a different story. The buyers were in control as the candle squeezed up, but it couldn't close at that level. The sellers pushed it back down. They left the topping tail, because of course the topping tail is the high of the candle, but now it's created this characteristic shooting star. A shooting star occurs when you've got a large upper candle wick and a small body. In fact, what this tells us is that the sentiment has already started shifting. It's already reversing and coming back down. And so when the next candle opens and goes lower and you have a confirmed red candle, it's not a surprise that that was about to happen. So in fact, when I see this candle, I can already envision that this is coming next, right? Being a successful trader, you have to get really good at pattern recognition. You'll start to notice when this happens, this happens. When I have 3 green candles and then a big shooting star, we have a red candle. And the more experience you gain, the better you'll get at developing your own sense of intuition, where you start to see this candle forming and you realize, uh-oh, I know what's coming next. It's gonna be a big red candle. I better get out of the way. I don't wanna be holding this as it starts to drop back down. So anytime we have a large topping tail that's starting to form, I'm gonna be concerned about a possible dump. So in other words, if you have a stock that has this nice rally up and then it has maybe 2 smaller candles here, you might be thinking, should I go ahead and buy this dip? Is this a dip I should buy? And I would say, first and foremost, we gotta be cautious because of this topping tail. Now, it doesn't mean this might not work. It could work. It could even rally all the way back up, but that's not typically what we would see. I have a book here. Let me share this book with you. This is a book by Annie Duke. I'll put it on the whiteboard here so you can see it. It's called Thinking in Bets. And in this book, she talks about the experience of learning to play poker. Her brother was teaching her. And he said, these are the hands that you should play. And she said, well, I don't understand. I see other people playing different hands. And he said, yeah, they've got a lot more experience than you. They may be able to have confidence trading those hands, but for you as a beginner, you need to trade the hands that have the highest probability. And as a beginner trader, I think sort of the same thing should apply. That as a beginner trader, when you see that big topping tail, you should probably say, nah, see, I know that that's going to create a higher likelihood of a reversal. Now, if you saw this pattern here, where you've just got a small green candle at the top, that's fine. Even if it's a medium-sized green candle or even a large green candle, that's fine. We then get a nice orderly pullback. But that topping tail creates a red flag. But what would this create? Now, it's a bottoming tail. Now, let's just forget about this topping tail for a second. If we just saw this bottoming tail, this is bullish sentiment. Why is it bullish? The stock dropped, yes, but just the way this is bearish, it's bullish because the buyers bought it right back up. It came back up higher. So this would be bullish, whereas the topping tail would be bearish. And of course, if we saw really high volume red candles right here, where this was the volume bar on both of these candles, that would be bearish, right? We don't want to see high volume on the selling. No. We want to see light volume on the selling. So the volume profile and the shape of these individual candles tell a real story. So one of the things that I can tell you is that because I've been trading for so long, I have built up a pretty deep library or sort of internal database of all of these nuances. And that creates the educated intuition that I have. If you want to do a 2-week trial, I'll put a link in the description. You could check it out, where you could do a 2-week trial and you could actually watch over my shoulder while I'm trading. It's $20 for 2 weeks, but you could check it out if you want. All right, so number 1, high volume red candle. Number 2, a large topping tail. Number 3, indicators of a dump is when a stock is not obvious. What does it mean for a stock to be obvious? Well, if we pull up our scanners here, in order for a stock to be obvious, it should be one of the top 3 leading percentage gainers in the entire market. You know, something that's kind of interesting that I think people sometimes take for granted or don't recognize is that we are the commodity for big brokers. Commission-free brokers, they make money the more we trade on the payment for order flow model. So they sell our order flow to institutions who essentially kind of scalp all of our trades for fractions of a penny. But when you multiply that by millions of shares a day, they're making billions of dollars a year. So the brokers have an incentive to encourage you to trade. Because the more you trade, the more money they get paid by those big institutional investors, or the institutional firms that are doing the alternative trading systems, the ATSs. It's almost like a version of a dark pool. So these brokers are going to encourage active trading by putting hot stocks in front of you. And they do this. They send out these emails of hot stocks today, what's moving today, what's moving today. And so these stocks that are in the top 3, top 4 position, it's almost like being on the top of a Google search. This is what gets all the attention. And if we look at the volume, the leading percentage gainer today, up 99%, currently has over 200 million shares of volume. AMPG has 182 million shares of volume, and a stock that I traded has 100 million shares of volume. Now, the bulk of the move from the stock that I traded actually occurred during pre-market trading right here. It began when the news first came out at 7 a.m. The stock was at $5 and it squeezed all the way up to 14. So this was a reaction to breaking news. Now, as the day went on, it ended up pulling back a bit, which was kind of a bummer, and other stocks ended up coming into focus, which is why AMPG and LASE have a bit more volume. But nonetheless, it's very important that you're focusing on the obvious stock. Let's look at this stock, JZXN, just as an example. This stock is popping up a little bit right now, and it's kind of an unusual time of day. Is there any fresh news on it? There's not. How much volume does it have? 400,000 shares? So is this an obvious stock? Well, it is up quite a bit, but with no clear catalyst and not a lot of volume, it's unlikely to expect that it will be able to sustain these levels. And so if you bought this dip, especially with this topping tail forming right here, you would probably be in a pretty tough position. Now, the volume profile, I'll say, is all right. It's not too bad, all things considered, but now it's getting worse. It's getting worse the more we look at it. See, this candle right now, this candle has 9 seconds left on it, the 5-minute candle. 7, 6, 5, 4, 3, 2, 1. Is it going to close red or green? Just barely green, but just barely. It almost went red. So technically, this is a green candle on the 5-minute chart, but it was kind of a battle there at the end, and this highest volume candle is actually red. And so this is not a dip, this is a dump. All right, so now let's go back over to CADL, and let's move this back up here. So number 1, high volume red candle's a warning sign. Number 2, large topping tail. Number 3, the stock is not obvious. When you're not trading obvious stocks, you're going to find yourself getting caught in a lot of choppy price action where the dips don't work. Now, why do these dips work? Why does this strategy work? Let's think about this sort of like just what's happening here. If we were going to describe this to a kindergartner, what's happening is you have the price that has moved up very quickly because people got really excited about it. They thought this was awesome. This is a lollipop company. It's a popsicle company. It doesn't matter. Everyone's super excited about it, wanting to buy it. But then kind of reality sets in. Wow, this thing is up a lot. It's up 40% on the day. Does this really make sense? And that's an opportunity where some people say, you know what? I was in from way down here. I'm going to start to sell. So people start selling. They start taking a little profit. They're up 40, 50%. In fact, maybe some short sellers begin taking a bet that this is overvalued right now and it's probably going to come back down. So there's a burst of enthusiasm in the market and exuberance. And then there's a moment of sort of coming back down to earth and like, let's get real. Is this really something I should be buying? And now at this moment, as long as the volume profile is strong, the buying was stronger than the selling. That tells us that as it started to pull back, people who could have sold to take profit are choosing to continue to hold. If they had sold, the red volume bars would have been higher. So they're choosing to keep holding. And in fact, if people are shorting, they're not shorting with enough share size that the volume is becoming disproportionate to the buying volume. So the sentiment is still strong. In other words, this had a chance to do a complete reversal, and it's not. Now, the fact that it's not dying by itself is showing strength. The bar is set fairly low sometimes. So now, all of a sudden, you've got low volume on these selling candles, and boom, the rally starts again. And now what buyers are thinking is, I'm buying something that is really strong, that only pulled back a little bit, and has the potential to go higher. And so this becomes the first dip on a strong stock. And that's what traders, especially like myself who trade momentum, love to trade. Number 4, we can't have the stock break below the 9 EMA on the pullback, on the dip. We really don't want that to happen. So that's one of the indicators that I'm using on my chart. And the 9 EMA is it's kind of not perfect, but the 9 EMA is the average price over the last 9 periods. And this is an important psychological level of support. When a stock is above it, it's bullish. When it's below it, it's bearish. So when we drop below this critical level, that indicates the bears are in control and buyers have lost control. So when we stay above it, the bulls are in control. Similarly, we never want to see that the price dips below VWAP. Now, you'll almost never have an instance where you'll be below VWAP and above the 9 EMA. That's very uncommon. They're rarely inverted. So by saying it has to be above the 9 EMA, kind of by default, I'm saying it should also be above VWAP, but just I'll articulate it just so it's very clear. So we want to see that it's above the 9 EMA and it's above the volume weighted average price. And then number 5, we don't want to see the MACD crossing. If the MACD crosses to the negative, that's indicating a higher likelihood of a dump. The MACD is the moving average convergence divergence indicator. And when you get that crossover, that's usually when you're going into a more sustained period of pullback, which can happen. I mean, even look, a stock can go up 300% and then it needs to pull back. So sometimes that pullback is just, it's bound to happen. It's not that big of a deal, but it's just not realistic to expect this dip is going to get bought up. And then number 6, this ties in the depth of the market. So when we pull up our level 2 window, what we don't want to see are large sell orders sitting on the offer or pegged orders. And I'll talk about those a little bit more in a second. But let's jump back into a quiz. All right. So what's this going to do? Is this going to dip or is this going to dump? Now this one's a little bit tricky because as I look at this right here, the MACD, it's almost crossing over. And yet the volume profile, not bad. The price, kind of hanging out right at that 9 EMA, but a little bit of a topping tail. So what do you say? Is it going to dip or is it going to dump? Well, it's a little bit of a trick. It didn't exactly dump, but it didn't exactly rip either. The problem was clear. MACD was crossing over, a little bit of a topping tail. It did bounce back up, but these made it a little difficult for this to rally way, way back higher. So, this is kind of the challenge. And one thing that I'll say is that if you're looking at a chart and you're asking yourself, is this going to dip or is it going to dump? And you really can't tell. If you can't tell which it's going to do, the right thing is to not take the trade because you're not sure. You really want to feel confident that you know what this is going to do. And in fact, it kind of boggles my mind sometimes how many traders trade from a point of uncertainty. You really need some conviction behind your trades. You want to look at it and be like, I know what this thing's going to do. This thing is going to rip. You want to have that level of confidence. If you don't have that level of confidence, then it's kind of like, you should not take the trade. That's the way I think of it. But it's easier for me to say that because I've been doing this for a long time. But you want to feel when you're looking at that pattern that you've got a really good chance of making money. Like you've got to really have some confidence. That's going to come as you gain more experience. So let's see. So this was Tara, Tara. This was a stock that was, however, really good. And now I can't remember if I have an example of it. But let's look at it. Let's look at it right here. Now it's easy to say because I can't give you the quiz because you already know the answer. But let's just dissect that moment right there. Now the stock had squeezed up. What was the position of the MACD? It was open. What was the position? What was the volume? Volume is strong. So nice volume, little pullback, and then that's a great spot for a dip and a rally higher. Even right here is a small dip for a rally higher. Those we can work with. Those are micro pullbacks, but I can work with that. Now let's look at this. This is RKDA. So what's going to happen here? Are we going to dip or are we going to dump? Now you should know the answer. You got to know it. At this point, just look at the MACD. Is it positive or negative? It's negative. What's it going to do? It's going to dump. It's not going to work. It's going to sell off. All right. So now we're starting to get it. Now we're starting to click. This is good. Let's look at another example. What's this going to do? Oh, see, now this is a little tricky. What's tricky about it is the MACD technically is still open, but the volume profile doesn't look so good. And we have a topping tail. In fact, this retraced more than 50% of the move. That's something that I could go ahead and add to this. So let's see. I'm going to add that to number 7. Retraces more than 50% of the move. So when a stock retraces more than 50% of the move, unfortunately, what often ends up happening is you get this dump. So let's see. So we'll pull this back up here. So is it going to dip or is it going to dump? And you can see right there, it's going to dump. It retraced more than half the move. So that speaks to sentiment. If it's not able to hold even half of the move, then it's not something you can trade. Now, I think it's also worth noting that just because you have a giant red candle doesn't mean that's a spot to buy. Yes, a red candle is certainly a dip, but the confirmation to buy is when it bases and then starts to curl. The version of a dip trade where you're buying something that's still selling is a bit more complex. That's something I would reserve for more experienced traders, because that's where you have to have the intuition that this is selling off and I think it's going to bounce at this level, but it is still actively selling. They also call that trying to catch a falling knife. It can be dangerous. You get practice, you get experience, you'll start to get a feel for the places stocks might be likely to bounce, especially when that rubber band gets really stretched out. It's going to snap back and you get a nice spring, but that's a little bit more complex. What we're talking about here is it going to dip and then rally and we buy that dip for the rally, or is it just going to dump? And so it's kind of that moment of truth of what's going to happen right in this spot. So now let's jump on to indicators for a dip. Okay, so we already talked about the indicators for a dump. High volume red candle. So we want light volume red candles. That's the inverse. So now you kind of already get the idea. Large topping tails. We don't want topping tails. In fact, we'd prefer to see bottoming tails. Stock is not obvious. Stock should be one of the top 3 leading gainers, preferably. Now, I will say there are exceptions to this, and there'll be exceptions to anything else. Just like anything else, there's some exceptions. You want to focus not as much on the exceptions, though, but on what generally is going to be working. So there are times where a stock might hit the scanner, like this stock, BEEP, and let's just say it hits the scanner and there was news that just came out within the last 2 minutes. Okay, so in that case, then, maybe this is something that we should pay attention to. It's not one of the leading gainers yet, but it has a really good chance of becoming a leading gainer if it keeps up. So that would be an exception, right around breaking news. Number 4, breaks below the 90 MA, right? So we want to see it hold the 90 MA. Don't break it, hold at it. We're going to add we got number 5, MACD needs to still be positive. Number 7, we said breaking below 50% of the move. So we want to say holding 50% of the move. By the way, we had I recently participated in a typing test, and I'm proud to say that I was the winner, fastest typer. Also had very low accuracy. And I said, this was a speed test. It was not an accuracy test. If you want me to be accurate, you should have said something in the beginning. So nonetheless, I say that for 2 reasons. Number 1, because I try to tell everyone about this success that I just had with this typing test. I'm proud of myself. Number 2, I actually do think that being a little faster on the keyboard will help you. And so if you practice improving your typing skills, it will help you in trading. Why? You've got to type things up pretty quickly, right? Let's jump onto the whiteboard. All of a sudden, boom, stock pops up. You got to type in the ticker. You want to press shift 1, shift 2, jump in and out of the stock. You got to have fast fingers. In fact, on a busy day of trading, you know what I do afterwards? I soak my hand in ice. No, I don't do that. But maybe I should, because these are very valuable. Hand model is what I could be. I need insurance on my hands. Okay, let's stay focused. So for real, guys, back to the screen share. All right, so indicators for a dip. If we have large sellers on the level 2 or pegged orders. A pegged order is an interesting order type where a seller puts out an order and it's not exactly a market order, but it can be a pegged order at the ask. So it'll sit at the ask price, and as the ask drops, the price automatically moves. So if you have a pegged order that's like a 50,000 share order, and then someone undercuts it, the order automatically moves, automatically moves, automatically moves. And this has the effect of putting downward pressure to push the stock down. So when you see a stock that has pegged sell orders, that tells me someone's really trying to get out and they're a little more sophisticated in their strategy they're using to exit. That makes me worried about institutional traders selling. And they can have huge positions, and if they're unloading, that could be a problem. And then when we have just big sellers on the level two, it's sort of similar. It doesn't matter if it's an insider selling or if it's a short seller taking a position. Someone feels that the right move is to unload, and it's a big position. So that's also bearish. So large orders is a problem. And then, of course, we already talked about breaking 50% of the move. And when in doubt, check the 5-minute chart. So one of the things that I can say is that it's very common that we'll have a stock that makes a really big move on the 1-minute chart. And we can look at CADL from this morning. So huge move on the 1 minute, which is awesome. We're trading those 1-minute pullbacks. But then we get to a point where, you got the MACD crossover here, but you look at the 5-minute chart and it's like, let's look at this 5-minute chart for right here. So back this up. All of a sudden, look at this 5-minute candle right up here. And actually, this is an example where volume weighted average price is above the 9 EMA on the 5-minute. So you actually have that that's inverted there, which is uncommon, but it's not great when we see that. So you have a giant shooting star, right? Sometimes traders get so fixated on the 1-minute chart that they kind of lose sight of the bigger picture. And the 5-minute chart is important. A lot of traders use it. And if you don't have a clean 5-minute chart, there's a lot of people who won't take the trade at all. So when you have a clean 5-minute chart, you're going to have that many more people buying on the 1-minute chart when it starts to break out. So usually when you have multi-time frame alignment, where the 1 minute and the 5-minute are both sort of supporting and giving you the same signals, that's when kind of the magic happens and we see some really nice moves. And it's also fine to have really strong moves on the front side when the 5 minutes just going more and more extended. That's a parabolic move. But once you get that first MACD crossover, that's the point to take a step back for me. All right, so now, so let's talk a little bit more. Let's look at this example. All right, so what's going to happen here? We've got a stock that's rallying up. Volume profile, solid. Green, big volume green bars. MACD's open. There's nothing about this that I'm worried about. This looks good. It's holding the 9 EMA. So what's going to happen? Awesome rally. Beautiful. Love it. 1-minute chart, super clean. All right, let's look at this. SNTI. What's going to happen here? So this one, lighter volume, pops up, higher volume selling candle there, higher volume selling candle there. MACD is still open. We have a couple of topping tails. I would approach this with caution, but my bias is to the buy side that this is a dip that's going to rally. And it's not just because I know the answers of the quiz before I gave it to you. It's because that's what the chart's telling me, but I do know the answers of all these quizzes. All right, next one, SNTI. Okay, so this one, this is a little bit tricky right here. So now the MACD is actually slightly negative. The MACD is negative, but high volume green candles, high volume green candles, high volume green candles. And we know that it worked before, right? If we've taken a trade on something we've already got a cushion, I may be willing to take the risk. What I look at here is more risk from the topping tails and more risk from the VWAP or from the MACD being negative, but the volume profile is strong. And this is a stock that is a 2.8 million share float. It's in the right sector that's currently hot, and it's the leading percentage gainer on the day. The MACD is negative. What do we do? Well, you could say no, and that would be okay. You wouldn't be wrong to say, I better be careful. It's always better to be safe than sorry. But the MACD did cross over, and as soon as it crossed positive, that was sort of your final issue. So you could have bought right here on this micro pullback, which would have been on the 10-second chart, once you got 1-minute confirmation. That would have been okay. And if you took a smaller position here, that would have been okay too. Smaller position, a little less risk if you're not sure, or of course, if you're really not sure, you don't take the trade at all. What about here? Now, this should be more clear. We've broken below the 9 EMA. We've got a stronger sell-off. MACD has gone negative. The volume profile is not bad, but unfortunately, this is not positioned to buy. And this ends up going up a little bit, but then ultimately selling off. So it doesn't hold up. What about this one? This tells me everything about this looks good. You've got a stock that's strong rally, it pulled back. The volume was higher on the buying candles. It did sell off down to the 20, but now it rallied back up, and right here is doing a micro pullback. MACD is positive. Volume is great. This is a buy. And we get a nice rally there from 5 up to 7. But again, if you aren't sure, it's always better just to wait. So right now, if we look at AMPG, this stock just started squeezing up and is on the scanners right now and actually just gave a nearly picture perfect dip trade. So let's kind of dissect this for just 1 second. All right, so you're sitting here and you see the stock AMPG hit your high of day momentum scanner. So the high of day momentum scanner, what's that doing? It's searching the entire market right now for stocks that are squeezing up that also meet the 5 pillars of stock selection that I utilize in my trading. So this tool has really been customized for traders like myself. I designed the tool, I had a development team build it out for me, and so all the traders in our community are using this software to find these stocks in real time. So AMPG hits the scanner. Now, I'm gonna make this just a little bit bigger. I'm gonna minimize the menu bar. So when it hits the scanner, it actually hits a couple scanners at the same time. It's hitting the squeeze alert up 10% in 10-minute scanner, the low float high relative volume scanner, the former Momo scanner, and the squeeze alert 52-week high scanner. All right, so when a stock is hitting multiple scanners at the same time, that for me reaffirms that this is something I really want to pull up and take a look at. Now, if you look at my P&L from today, I already traded AMPG earlier today. I traded it right around $2 and it ended up squeezing up to a high of 220 and it peaked at 219 and that was where I traded it and I only got out with a small profit. It dipped back down, it then kind of rallied back up and through the rest of the day it pulled back. But what ended up happening here going into the close is that suddenly it got another burst of momentum. So right here, it's now back in play. It was in play here, it was sort of in play here, and then it's been out of play this whole stretch. If we looked at the MACD, our moving average convergence divergence indicator, you would see that we had the first leg here where the MACD was open, went negative, and then it opened up again for another stretch right through here. And then through this area, broke below volume weighted average price. We gave back too much of the move, wasn't that strong. And then for whatever reason, it kind of perked back up after hours. So one of the catalysts for this type of move can be, it's not that it has fresh, it already had news earlier. It's not that it's got extra news right now, but there are traders out there who were likely swing trading this to the short side, thinking that it was going to just slowly unwind and go lower. And that would have made sense when it was under volume weighted average price. Right here, stayed below it. Right here, stayed below it. Suddenly, into the close, sentiment shifts. All of a sudden, it's back in the hands of the bulls. It's above VWAP. It rips right here. And in this leg, would you have chased it? So here's the problem. As a momentum trader, if you saw this right here, this is where it's hitting our scanner going from 2 to 210, 220, 230, 240, 250. And this is where a lot of beginners are going to say, I'm just going to jump in right here. And you know what? In a really hot market, you might be able to get away with that. But it's risky to jump in something that's that extended. It's always better to wait for a little bit of a dip. So it starts to dip right here. This is now the moment where we've got to do our, kind of go through our tips and tricks. How do we analyze, is this something we should buy? What's the volume profile? High volume buying, excellent. Low volume on the red candle, relatively, compared to all the volume that we had in the buying moving up to this first red candle. So we had 2, 4, 6, 8, 10, 12, 13 green candles in a row. One red candle, it pulls back. It dips a little bit further, another red candle. What's the position of the MACD? It's still positive. Where's the position of our 9 EMA? 9 EMA, we're right here. So this is the spot right in here. It's now basing out. So what I do is I draw a line at the low of the pullback and I say, that's the low 225. Okay, so that's my stop. It comes down, it holds 225. Do you see how it holds that level? Firm line in the sand. People are buying off of 225 and we're looking for a move higher. So 225 is the entry, and then there you go. Look at that rip back up. So now you've got this nice move up. Now, the only thing that's a little tricky here is that the MACD did come pretty close to crossing. And what can sometimes happen, this is not super ideal. This is now after hours trading. After hours trading can be lighter volume, so it's not the best time for most momentum traders, but in any case, it still ended up being a nice dip trade. So it pulls back here. It did go kind of sideways for a second, So rather than kind of having this more like V form, it sort of pulls back, goes sideways, and then rips up. So there it goes all the way up to 272. Pulls back again, position to MACD, still positive, light volume, and then this dip gets bought up again. And you can continue trading these dips until you get a point where finally the MACD crosses over, you have that higher volume red candle, and you have really that clear confirmation that we're pulling back. And this is also where, well, let's double check 5-minute chart. What's the position of the 5-minute chart? Okay, we're still looking fine. We have a couple of little topping tails, not huge, not crazy dramatic, but a little bit there. I would also look at this chart just to identify nearby resistance. We had resistance probably at the $0.50, hit that level, pulled back, got above it. Now we're above it. We might retest it on a 5-minute pullback. And then if it bases out, rally higher. But as it's getting later in the day, we start to lose likelihood of having that momentum. We also can pretty convincingly say the volume right now is a lot lighter than it was earlier. And this is an interesting divergence when a stock moves to new highs, but on light volume. Usually when this happens, it's because traders have just sort of stopped trading it. And so volume sort of tapered, it declined. High volume on this red rejection right here, but volume kind of declined. Traders sort of gave up on it, including sellers. So then all of a sudden it starts to rip, and it didn't take that many buyers to create an imbalance between supply and demand because just less people were trading it in general at this point. So that's where you sort of have that shift. You get the break of VWAP, there's fewer people focusing on it, and all of a sudden the buyers have a little bit of an edge. As the sellers are gone, it starts ripping back up. And anyone who is holding this as a swing trade for a short is now got the pressure on as this thing is back at the highs. So we're now up 170% on the day. And sometimes this is a stock that could carry over into the next day. And we may end up taking more trades on it tomorrow if it continues to hold up. But if we do the trades tomorrow, just like the trades today on CADL, the best trades will be buying the dips when it's on the front side of the move and the MACD is positive, right? So I just want to kind of pause just for a second just to show you this, because this is a nice, real-time example of that price action. And it really a clean dip. CADL, this one, the price action really consolidated very beginning of the move and then pulled back. And this is something that sometimes happens with biotech stocks where initially you'll have a big reaction to the news and then more sophisticated people in the industry say, well, wait a second, I know what this actually means for the industry and what this means for this company. And I don't know if this is going to keep going higher, and it'll start to unwind. Or you have a stock like we had back in October, November, that has that kind of move and it just keeps going higher. This stock went from $2 a share to nearly $80 and is still holding at 40. So it's like this one's still not dying, and it's kind of crazy. Okay, so a little bit of a tangent there. Let's get back on topic. Now, the type of stocks that I like to buy dips on, the stock should be obvious, it should be moving quickly, and it should be attractive to retail traders. These are my 5 pillars of stock selection. And I will say that my criteria for stock selection can vary slightly based on current market conditions. In fact, today, if we look at the trades on CADL, let's pull up CADL because this is a stock that I traded, up $37,000 on the day, $36,900 of it on CADL. This one actually had a slightly higher float of 17 million shares. It's a little higher than the profile of the stocks that I've been really dialed in on lately. So this is the profile. Number one, has to have 5 times relative volume. That means the volume today is 5 times higher than its daily average. So let's look at the volume yesterday on CADL. We'll just check our daily chart. So yesterday's volume was 700,000 shares. Today's 100 million. Wow, that is crazy. That's over 100 times higher volume today. Okay, so check. Definitely meets that criteria. What was the next one? Number 2 is already up 30% on the day. So when I took my first trade on CADL, I actually I wasn't really quick to break the ice on it because the float was higher. I wasn't sure. I said, with that higher float, I'm not sure if this is going to work. However, once it started to pull away right here and right here, I bought this dip right here. I bought that dip, and then I bought the next dip that formed right through here. And those ended up producing some really nice trades. So I got focused on the dips once it started to pull away. My first trade was right here, just around $9 a share, a little over $9. And then my second trade, which was a really nice trade, was right here on this breakout. This is a 10-second chart, which every 10-second chart, basically, it just is a zoom in of a 1-minute chart, but it gives you a little bit more clarity. I was, I'll say, a little nervous on this trade right here because we did have this higher volume rejection, this red candle. But what I said was that it needs to tap the 9 EMA. I think it should find support at the 9 EMA. And once it finds support there, then I think we're going to be in better shape for a rally up. And that's when we got the move to 1250 and then that pullback higher. So anyway, so when it first hit my scanner, when it was at like $5, it was already up 15-20%. So I think this was already up almost 100% by the time I traded it. And that's not too much. I don't have such a thing as too much. I'm not investing to hold this for months and months. I'm looking for a 15-20 minute long trade, maybe at the most. I'm happy with a 2-minute long trade if it gives me a nice trade in that short of time. So for short duration, I'm buying high and selling higher. Number 3, there should be a news event that's moving the stock higher. That was the case with CADL, phase 3 trial results. Number 4, the price ideally between 3 and 20. That seems to be working better right now. And number 5, the float or the supply, the number of shares available at trade should be less than 5. This one was 17, so it's a little higher, which gave me reason to be cautious. But when it started to pull away, I was like, all right, well, clearly this thing is moving. So what I'm also going to do for you guys, I'm going to put a link in the description where you guys can check out. Let's see, I've got it's going to be on this slide here, and then we'll jump back. So you can get instant access to my micro pullback strategy PDF and my small account strategy worksheet, my pre-trading checklist, a live trading archive that I record for you guys, and a special video on about how to hold your winners longer, why traders hold losing trades too long, and how to do the opposite, which is to hold your winners longer. So I want you guys to check that out. And in that, I will also have my stock selection criteria. So you can learn more about stock selection. Okay, so the type of stocks I like to buy dips on, the stock should be obvious. It should be moving quickly. It should be attractive to retail traders. In other words, it meets this profile right here for being the right type of stock to trade. At that point, it's on my scanner. I'm seeing it hitting the scanner, and I'm looking to buy the micro pullback. And this takes the form of a dip. This is a small, very quick dip. And then we look for that rip higher. That's what I'm looking for in this setup right here. So what we can see is you've got the beginning of the move, the pullback. This candle becomes your trigger candle. So what that means is that the high is the entry and the low is the stop. The way this works is that we look at this candle as any of these candles could be the trigger candle. What has to happen is after the pullback, you need the first candle to move higher. So right here, we're going lower, we're going lower, we're going lower. We're trending down. For that trend to reverse, this candle, at some point, a candle needs to make a new high. And so we keep watching the high of the candle and the low. So let's say the high is 510 and the low is 490. So if this breaks 490, then it's just continuing to go lower. If this breaks 510, we've got our first candle making a new high. So we're buying right there the second it breaks 510. Maybe we get filled at 511 or 512. What's our max loss on this trade? It's down at the low of 490. So now we're risking 490. Now we're risking 20 cents, 22 cents a share. How much do we need to make on this trade to justify the risk and reward? So we've got 1 part risk and we want to have 2 parts reward. So that means we get the pop up, we get the pullback, we're in down here. We've got 20 cents of risk on the trade. We now need 40 cents of profit potential. So that's going to be our goal. Now, one of the things I love about dip trades is that when you're buying on these pullbacks, you can get really tight stops, oftentimes much tighter than 20 cents. 10 cent stop, 12 cent stop. And then if you can make even just 20 cents, you've got your 2-to-1 profit loss ratio. You only need to make half as much as a trader who's buying higher in order to have an even better profit loss ratio. And the better your profit loss ratio, the easier it is to be successful because you don't need high accuracy. This is the relationship with profit loss ratio and accuracy. If you're right, if your average winners and your average losers are the same, you need to be right 50% of the time in order to break even, right? $100 winners, $100 losers, 50% your break even. If your average winners are 200 and your average losers are 100, you actually only need to be right 33% of the time in order to break even. But if your average losers are 200 and your average winners are only 100, you need to be right 66% of the time just to break even. And this is pretty dramatic difference, right? So a trader who's buying dips can be in this area, whereas a trader who's buying the high a day entry is going to be up in this area. Both could be profitable, but you can be profitable here with 40% accuracy, 40, 50% accuracy. Down here, you're going to have to be right 60, maybe 70% of the time in order to make money. So you're going to be better off. You're going to set the bar lower if you could focus right in here. Now, what this means is, number one, you've got to make sure you're trading the right stocks. So you've got to have stock selection dialed in. Stocks that meet the 5 criteria, stocks that are obvious, attractive to retail traders, and are moving quickly. But then you also need to make sure you're getting the right entry. And to get the right entry, you've got to understand the language of technical analysis. You've got to get so good at it. And this is where the more you practice, the more you trade, the better you'll get. It's just one of these things that you've just got to stick with it. You've got to practice. You've got to build your own educated intuition. So I love the micro pullback because for me, it's one of the fastest ways that I can get in a strong stock. So if we look back at a lot of these examples and we look at the CADL today, that first entry, we had to look at this on a 10-second time frame because that dip was so brief. It only dipped for a moment before rallying back up. But I knew based on the profile, the volume on the 1-minute chart and the candlesticks that this was something I should pay attention to. And then this pullback right here, again, I mean, it just rips right through that level. So when you have something that's really strong, especially when it's strong because of breaking news, these often won't give you a lot of time to sit around and twiddle your thumbs. If you want to trade it, you've got to get in fairly quickly. And that's where the micro pullback is a key strategy. It's buying the dip. The dip is the micro pullback. It's buying that micro dip before the next leg higher. And so that's where I really think the more you practice, the more you watch these charts, as long as you're trading the right stocks, the ones that are obvious, this is going to start to click. Learning a language of financial analysis, technical analysis, the financial markets, it's not unlike learning a spoken language. You've got to immerse yourself in the culture of other people speaking the language. You've got to hear it. You've got to see it written, everything. And with trading, being in a community of other people that are speaking the language, listening to these episodes right here that I upload every single day, this is going to help you in that journey to gain this financial literacy. I mean, that's really what it's about. It's about learning the language. So the micro pullbacks, again, I've got a PDF that you guys can you can download. This micro pullback strategy PDF, you can download, you can print it out. And it's going to show you the different variations of the micro pullback and how they look between a 10-second, 1-minute, 5-minute chart. They can look different. So you got to be able to identify them in real time. This is an example here of a nice micro pullback. So here we've got this stock that kind of rallies up, dips for just a second, micro pullback. Rallies higher, dips a little bit more sustained, another push higher. So like that's that setup that we look for every single day. And when you have a stock that's got a 600,000 share float, that's got breaking news, that's when we see stocks go from $2 to $3, $4 in a matter of 15 minutes. It's kind of crazy how fast these can move. So now you've taken your entry, right? And then this was kind of to walk you through where I'm buying these stocks. I let the dip form, right? So we get the squeeze higher, we get the move up, we then get that pullback, we get those 2 candles. First candle makes a new high. That's my entry right there on the micro pullback. That's where I'm buying. So that's my buy on the dip. Now where do I sell? Where's the exit indicator? How do I know when and where to get out? So what's kind of interesting here is that your exit indicators also kind of overlap with what would tell us not to take the trade in the first place. If we have a high volume red candle is an exit indicator. That's telling us people are bailing on this. They don't like it anymore. They're not confident. So we got to get out. And then a topping tail, large topping tail. That's an exit indicator. Stock's no longer obvious. Something else is taking its place. This is something that can be super frustrating with trading. You can be trading a stock and all focused and dialed in on it, and then another stock comes out with breaking news and everyone switches to trade that stock instead. And you're like, are you kidding me right now? What happened to this one? Everyone gave up on it. And so you got to be able to follow the momentum around the market. It can move quickly. So if the stock is no longer obvious, time to jump out. Breaks the 90 MA, MACD crossover, large seller, pegged orders, those are exit indicators. Building success as a trader is a combination of discipline and strategy. You've got to have discipline, you've got to have the patience, the discipline to follow the rules, and you've got to have the strategy. When these come together, that's when things get really exciting. What I want to help you achieve is a positive feedback loop. The first element of managing risk, in my opinion, is trading A quality stocks. When you trade the right stocks that meet the 5 criteria of stock selection, stocks that are obvious, stocks that retail traders like, stocks that are moving quickly with news. By trading the right type of stocks, you're going to find that the dips are more forgiving when you're trading the front side of the move. Front side of the move, when the MACD is positive, that's when a lot of those dips are going to keep getting bought up. Once the MACD crosses over, that's the time to take a step back. So managing your risk can be done through stock selection, making sure you're trading the right stocks and trading them in the right places. By increasing the focus on accuracy, trading highest quality stocks and the highest quality setups, you know what follows? You increase your accuracy, and now your profit loss ratio gets better. Because what you've done by increasing accuracy is eliminate some of the outlier losses that were drawing down your profit loss ratio, because your profit loss ratio is all your average winners and all your average losers. So when you've got poor accuracy, you expose yourself to unnecessary big losses. That hurts your profit loss ratio. So higher accuracy leads to improved profit loss ratio, which leads to improved consistency. And what does that do? That creates a better track record, which builds self-confidence, which helps you increase profitability. This is getting into a positive feedback loop. That's what I want to see. Now, you know what happens to a lot of beginner traders? A lot of beginner traders are on the exact opposite. They're in a negative feedback loop or a downward spiral. And it begins back here with poor accuracy. They don't have good accuracy. So they don't have good consistency. They don't have a good profit loss ratio. They don't have a track record. They don't have profitability. They don't have confidence. And in fact, as desperation and pressure gets higher, their accuracy goes down even more. And they start taking more and more trades that are terrible quality, and they start spiraling. So if you're in that position, this is what I want you to do. Stop right now. First of all, stop the bleeding, switch to a simulator. That's number one. Number two, focus on accuracy. Focus on highest quality stocks. Accuracy first. You're going to notice a difference. You're going to trade less, but you're going to be trading the right types of stocks. So the next steps to keep learning, well, you saw the link. Download the Dip Trade gifts. So there's a bunch of gifts, free PDFs that you guys can download. You can get instant access to them as part of this dip trading class. And if you want to take the leap and watch over my shoulder while I'm trading every single day, we've got a 2-week trial. Link is pinned to the top of the comments and linked in the description. And I want to thank you guys for tuning in. And I hope you're already subscribed to the channel. But if not, you can hit that subscribe button. I'll remind you guys, as always, look, trading is risky. My results aren't typical. I've been doing this for a long time. So what I want you to do is to start slow. Build experience in a simulator, and only once you've proven profitability in the simulator, transition to real money. I have a trading plan that you can follow that I give to students at Warrior Trading. So hope to see you guys over in the community. And I want to thank you as always for tuning into this episode, and I'll see you for the next one real soon.